Robschild, no investment advice, gonna do a quick show today. Also, I don't think I'll have time to do a show Friday or Monday, and I've been thinking about generally having less macro Mondays, especially if there's no updates. I can just refer back to the last one unless there's any significant changes. Anyhow, let's do the ding and let's begin. So today is Thursday, December 12th, 2024. Today's episode PPI. I heard people say this morning that the PPI looked hot. Yeah, I mean, it was expecting 0.2% and came out at 0.4%. But I find it notable that the core, which excludes the food and energy, was actually only 0.1%. Notably, that's only 0.2% away from a negative number. I mean, that's low. It's lower than the 0.3, is lower than the expected 0.2. And then the core year over year, it's the same as the last month at 3.5%. I mean, with food and energy, yeah, we went from 2.6 to 3, but that's more volatile. It's less important. The core is the one that we should be paying more attention to. It's a little more secure. It's also notable initial jobless claims came out higher than expected by 22,000. Last reading 224,000, expected 220,000, said 242,000. Second agenda item, yield curve reversion. With the cuts being more sure, it's almost like drawing them closer. The fronter end of the curve can be allowed to go down a little bit more, and the back end of the curve, the TNX, the 10-year, going up on the same time. This is not really bull steepening or bear steepening. Bull steepening is bad because, it just means that, the front end is being pushed down to get things going again. The bear steepening is actually the actual soft landing. If that happens, if the front end just stays where it is and the long yields just rise along with a heating up economy, that's when you get the soft landing. Never happened before in history, but that's the idea. So we're getting sort of both at the same time. So looking over at the curve, this is such a great website to check on a daily basis, USTreasuryYieldCurve.com. We can see the front end is now decisively below the 20-year. And are we equal to the 30-year now? 30 years at 4.55. Yeah, so now it's equal to the 30-year, whereas I believe yesterday it was equal to the 20-year. It was completely flat. We're getting reverted. What do you expect? We're at the cutting cycle here. Just a matter of time before things really blow up. Also, very notably, the 3-month and the 10-year are getting just really close. It has to do with the 10-year going up today, and the 3-month being only at 4.35, while the 10-year today on this chart 4.32. So an inversion of only 3 basis points. Wow. The 3-month, 10-year, the one that I've been talking about, the one that everyone talks about all the time, we're like, it's going to happen maybe tomorrow or Monday, the reversion. And that's it. That's we're in a recession kind of a thing. At least that's according to me and my crystal ball. No changes in daily reminders. Watch 12:9 Brassy Clock to hear me read through it. No changes in the crystal ball readings. Also, watch Monday's show to hear me talk about it. On to the charts. SPX, S&P 500 going sideways. I don't know if it's going to go up or down. No idea. TLT caught me off guard today. I wasn't expecting rates to pop up. I was thinking that we'd at least stay within this megaphone looking pattern. We broke clearly below it today. Some professional traders can see this as you can see from November 22nd to the 25th, we had what's called a gap. And oftentimes there's enough liquidity sort of that wants to play around in that area. So we call filling the gap. And that it looks like maybe that's what we're doing. We headed straight into it. And so we kind of have to fight it out to see, If the bears or bulls will take over from there and either go up or down. I don't know where this is going super short term. Looking at the 3-month, 10-year, basically very, very close to reversion, I'd expect money to start really pouring into treasury bonds here. But, it's not like I do have a crystal ball. Of course, that's what's going to happen. I mentioned the MOVE index being surprised about, TLT sort of dropping in price on the same day as bond volatility dropping. Pretty interesting. Oh, this is a weekly chart. Let's switch it to the daily. Yeah. So again, we haven't been this low in a while. The truth is, part of this is the weighting of the MOVE index that needs to be considered. You can just Google it here. It's pretty easy to find. 20% for 2-year treasuries, 20% for 5-year, 40 for the 10-year, and 20 for the 30 years. So it's more weighted on the longer end of the curve, but there's 40% through the 2 through the 5-year. And so what I'm thinking here is that maybe there was more volatility expected in the short end of the curve that is now kind of exiting the market because it's more and more clear and more confident that the Fed funds rate is going to be cooling off here. So despite the drop in TLT and the rise of the 10-year through the 30-year, there's enough reduction of volatility. Also, if you zoom out on the MOVE index, that's why I had it on the weekly chart in the first place. The MOVE index has been elevated ever since 2022. People have been expecting more volatility in treasuries for a while, and so we could consider this maybe just reversion more to a more normal state. Perhaps this is the calmness that the market needs before the real storm begins. And that's all. Again, I might be able to do some kind of streaming thing Friday and Monday. I'm going to be out of town, basically. So I'll be back on Tuesday. One more thing before I go. MSOS dropped today. I did buy with 1%. 1% of my portfolio. MSOS, I think, it was yesterday. And we went down another 5% today to now a price of $3.60. It's amazing. I mean, people, these are majorly distressed assets. They're being sold at a loss. People are willing to take the loss. They can't stand the pain anymore. And my take on it, again, is that I don't think this industry is going away. I don't think these companies are worth nothing. I understand the headwinds of regulation, taxes, etc., but I might draw a parallel between this industry and maybe the alcohol industry, during the Prohibition era. I don't know. I have my doubts about us getting into that kind of a period despite the politics, but maybe it could happen. I mean, worst thing that can happen to me, I lose 1% of my portfolio. Boohoo, that happens that can happen in the S&P 500 in one day, so not a big deal. And at this price, it's, I don't know, for me it's worth speculating. I mean, it was only when was it? It was only like a month ago. This entire fund was already at like a 90% discount and double the price of where it is right now. So if you just waited to get back to that already insanely low price, you'd double your money. But yeah, I'm not sure where the fear is going to end. I'm astounded at how low this, and this is an industry. This isn't one company. That's what's really so astounding about it. But yeah, who knows? Maybe it'll go to zero and I'll lose 1% of my portfolio. Anyway, that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time, Robschild. I'll do the ding. There you go.